Welcome back to Take Flight Podcast, your favorite quartet. Myself, Shawel, Pabilo, and Olu. In this week's episode, we're going to talk about another business which you're all very familiar with, and that is none other than Netflix. We're going to talk today about their business, what's gone wrong, why it's gone wrong, and what we think they could do to turn it around on its head. So stay tuned, stay strapped, and welcome to Take Flight Podcast.
Take off, take flight with you. For we never fly, but we're flying.
So before we get into this week's topic, which is going to be around Netflix, I just thought we'll see how everyone is doing. So P, how are you?
I'm good. I'm well. What's been happening? No, pretty good. I think now a week since Ramadan, so the focus is really to get back into peak routine. And so it's just basically, from the moment I wake up to the moment I sleep, just trying to perfect my time. But yeah, it's good. I'm well. Family's good. Yeah, no complaints. No complaints. Just got to keep going.
Olu, you're looking really chilled. How's it going, CFO?
Yeah, exactly. Are we gonna do a round of applause?
Well,
for that?
let's
That's not a light title.
But Daniel, you need to come on. It deserves a bit more than just the.
Okay, so for the listeners who aren't aware, who don't follow maybe me or Pabilo on Instagram or Shawel, wouldn't have seen that Olu hasn't tooted his own trumpet, but we've celebrated him for his most recent recognition in the professional arena. He's been now promoted, elevated, and leading a division. He is now CFO, Chief Financial Officer, Olu Okonola.
Round of applause, guys.
Thanks. Thank you. It's been a big week. So I officially started a role on Monday, or for the listeners, the previous Monday from when this episode comes out. Really excited. This has been a long time. I think I remember when I started my career and I used to say, I would want to be a CFO. I would, if I'm honest, during that journey, I did maybe consider not becoming a CFO or not wanting to. But sort of the last few years when that opportunity started to open up in terms of what do you want to do next? Where is the next progression, development, an area that you could add value to the business? That CFO role came up and yeah, applied for it. It also shows the power of building great network. Like you never know who's watching you and who's watching your current, or like what you're doing in your current role. So like the GM of that site and the new VP were like, Olu would be a great candidate. So I'll do a takeaway episode, sort of breaking down sort of how this came about, because I think for some of our listeners, right, it was only, I would say a few months, maybe a year or so, where I was almost made redundant. So it's like going from potentially being redundant to becoming a CFO is a drastic change. And it shows the power of just really investing in yourself and believing in yourself, right? And not settling for a particular role and wanting some form of change. And right now I'm just learning as much as possible, leveraging my network. I think I've got a great group of people, the guys on this podcast, and some other people, family members and friends who have given some great advice. I think one great advice that I've received is actually from one of the guys on the podcast. I won't mention any names, but was just around like a 90-day policy or framework to go into this role, where you just focus on like the people, the processes, and the product. And that's been very helpful in day one. Just getting in and understanding the people, letting the team understand my style. But yeah, I'm extremely excited. I'll break it down in one of the takeaway episodes. But thank you guys, and thanks for your support over the years.
Pleasure. Oli, I was about to cut you off there because I was about to say that's a take flight takeaway there, man. You need to
I was about to do an episode.
I think you would have thought the guy won a BAFTA award.
No. If it was a BAFTA, I would have started with
you had it prepped.
first,
you had it prepped,
and then
you had it prepped.
He's gonna ask to get that cut out and say, "Yeah, that's my takeaway episode." But sure, how's things?
I was listening to Olu then. Olu, I have to say I'm very proud of you, bro. I think from 2019, from when we started this podcast to everything else that's happened between now and then. And I think what you just said, that's a great title for a takeaways episode, from redundancy to chief financial officer. It's been a solid journey, but congrats. And yeah, super proud. In terms of on my side, all good. As P said, similar post Ramadan. It's been a week now, so trying to get back into the flow of things. I'm still in the UK, but I'll be heading back to Copenhagen this weekend, just catching up with family, friends. I went to a really cool networking event last week now, and that was really good as well, just to be out in the space, connecting with old friends and making new friends, and some potential podcast guests for us later in the year. But otherwise, all good, and yeah, just getting back into the swing of things.
If
Daniel.
anyone follows Shawal, they would have seen the swag in terms of it felt like it was a photo shoot. that meetup that you had. That suit was looking on point.
Crisp.
I think that's the nicest thing you've ever said to me, Olu. I'm liking this vibe today. But Daniel, Mr. Johnson, how are you doing?
I'm not gonna lie, I'm tired. I'm tired. I am tired. Yeah, just on a personal front, just trying to still adapt to these restless nights or interrupted nights at some stages are tiring, can be felt at times. But I think once I start the day, it's fine. But initially in the morning, it's a bit of a sluggish morning. But apart from that, all good. Enjoying life, living life, working hard. Family's good. So yeah, that's the most important thing, that family are good and healthy.
But just with that, for the listeners, in case you haven't had the chance to listen to it, I highly recommend listening to Daniel's Take Flight Takeaways, where he talks about the first 90 days of fatherhood and working at one of the hottest companies in the world right now, and how he's been able to balance. And on top of that, some bonus travel tips as well, if anyone has just recently become a father. So highly recommend checking out that episode.
Great. So I think with doing all the formalities, seeing how everyone's doing, we're going to get right into the episode, get tucked in. So Netflix. Everyone has probably heard of the name Netflix. Most of us, I'm sure, are users of Netflix or someone else's account. But I want to take a step back to think about the initial business model and how it's evolved, and to sort some of what's going on at the moment. So just for some context, software engineers, two of them, Reed Hastings and Mark Rudolph, founded Netflix in 1997. That is quite a long time ago, but many of us probably think it was in the noughties, but it's actually not. It was 25 years ago. It was a video rental stores. As the video rental stores dominated the home entertainment market, Hastings was frustrated in that the market was not customer friendly with charging the customers high fees for late returns, and they saw an opportunity to do rentals differently. And Netflix began renting out DVDs by mail. And in 1998, which was a game changer for them, the video renting market was a huge gamble. Their VHS dominated the market, and only 2% of the American households owned a DVD player. And at that time, Reed and Rudolph knew it was time for them to enter the market by hoping the market would reach 20% of households. It went from a renting business model to subscription. And I say that because the first model was to let people rent videos by selecting them online and having it delivered to their door. This service was actually unparalleled at the time, and it was a big shift in the industry. A year later, Netflix introduced a subscription model where customers could rent DVDs online for a fixed fee per month. And later, as we know, they implemented artificial intelligence and AI technology to not only give you more content, but to recommend content to you. And I must say that in the early noughties, before the subscription model, I remember someone actually received a Netflix DVD in the post, and I was like really surprised. Like, what is this? Like, why are you receiving a DVD in the post? I was very much accustomed to Blockbuster, where you'd select something, whether it be a game on your Xbox or PlayStation, or a VHS or DVD, as it then later became. And I was like really wowed by this, and thought, how did they actually entrust their customers to return a DVD? For me, it was quite bizarre to know that I can order a DVD online and they've entrusted me to return it, not make a copy of it, and not to keep it. So it was really, really fascinating to me. But that's kind of how the business started. We all know that Blockbuster at the time was dominating the market. They're on everyone's high street. We all probably had a Blockbuster card. We'll go with our parents to try and get maybe a rated 15 movie when we were 13 or 14. And who knows who was trying to get an 18 at a young age, but yeah, that weren't me. But that said, I think, in the last couple of months, or in the last month, let's say, it's almost as though Netflix has had a similar story to Peloton, where the pandemic was really, really good for them as a company. Revenues were sky high, and it was almost like it was too good to be true. But now, behold, now it's taken a tumble. We'll go into the numbers in terms of what that means, how that's played out. But I thought we'll just open up to say, firstly, is everyone here a customer of Netflix?
Yes.
Wait, do you
Shaw's
do you
got your
have
hand
your
up.
own? Do you have your own?
No, that's to
account,
say. That's
or-
just to say yes.
No, so I've got my own account. But my account is also shared with someone else.
Okay. And how about you,
Sure.
Shaw?
I'm part of the 100 million that is account sharing.
Yeah, my one is we have a family plan, so we have 4 accounts with one subscription.
Okay. Wait. Backtrack. P, you said it's your account that you're sharing, or someone else's account that's sharing with you.
No, it's my account, but it's been also
Okay.
used by someone else.
Okay. Ollie.
I share multiple accounts. I've never purchased. I've never purchased. a Netflix account. I purchased. I've used multiple.
Hang on.
Let me tell you.
Wait. Let me
tell you a funny story.
Olu,
So
just to get this
funny-
straight,
yeah.
just to get this straight, the chief financial officer here is actually sharing passwords and accounts.
How do you think I stay financially stable? It's not by pay for Netflix. You know what's so funny? A friend of mine I'm not gonna expose the person, but she was telling me how she was using the Netflix of her ex-partner, and she had been using it for like years after they broke up. And then finally one day it just cancelled and disconnected. And she was like, I feel like reaching out to him and just seeing if everything is okay. Like, is he struggling? Is that the reason why he cancelled his Netflix account? But it's so crazy the amount of people that are sharing accounts.
You want to know what's interesting? Because obviously this is a topic that we're going to discuss in terms of one of the factors. But it's got to a point where people are accustomed to sharing accounts to the point where when that account eventually disappears, like what you just said, you actually feel like something's been taken from you, as opposed to realizing it was never mine in the first place. Like we had, we were using a Disney Plus account, right? So Karim's lapping up, he's watching these stuff, and then he gets closed. I'm getting vexed because I'm thinking to myself, who do I call? Who do I? So it talks a little
You
bit
can't
about
call
psychology
you can't
behind
call
it as
Disney
well.
helpline.
No.
But
What about
Daniel,
yourself,
you were a subscriber of Netflix.
No. I'm not a subscriber. I'm a user. As in, an account was shared with me, and a profile was created for me, and I just tap into that. But in all honesty, I don't even watch Netflix that much. I got access to it via my cousin, but I'm not a heavy user. Not a heavy user at all.
I hope Daniel and what we said on this podcast is not used against us, because Netflix is now struggling. So I don't want the police knocking on our door saying, "Hey, you guys owe us some money."
Well, I didn't put the password in; it was put in for me. But so
Okay.
mine's a different story, Ollie. But on that note, I think we'll kind of start off with kind of their performance, because I think that's what's top of mind for a lot of people at the moment, in terms of their revenue earnings for Q1, and there was a day where $50 billion was wiped off their market value. So just to give a bit of context, so Netflix's revenue for the quarter ending March 31st was 7.87 billion, which was actually a 9.83% increase year over year, but actually fell short of analyst expectations, which was anticipated to be 7.93 billion. And Netflix's revenue for the 12-month period ending from March 31st, 2022 was 30.4 billion, a 15.2% increase year over year. However, the net income during the quarter of this year fell 6.4% to 1.6 billion, down from 1.7 billion the year prior. The company earned $3.53 per share, which is well above the $2.89 per share analysts had expected, according to a Refinitiv survey. Despite kind of a better quarter year on year, Why do you guys think Netflix has had sort of a bad press around? Of course, they mentioned or anticipated 2 million users lost in the next quarter, but you would argue that where you haven't had a loss year on year for net revenue, why do we think there's been bad press around it? That's what I was really intrigued, because you ultimately think 50 billion wiped off. There must have been something that's happened. It wasn't like the case of Peloton where demand and warehouse and storage costs and etc. But I thought I'd open up to start with why do we think there's been negative connotations with Netflix's performance?
I don't mind starting off. I see it's tough, right? Because there's a lot of fear in the market, rightly so. Just in regards to interest rates. I think we're seeing Fed mention that they're planning to increase interest rates, and companies which are heavily debt reliant, and I believe Netflix has got probably around 15 billion or so, are people looking at, okay, how is this going to look like in the future with this long term debt? They're not able to pay it back through their cash flow. So they're going to rely on these long-term debt. If they have to renegotiate new interest rates, what is that going to look for the business and the profitability? So I think that's one of the elements. The second element is really around, I think, what you mentioned around the outlook for subscription. Now, in Q1, it wasn't such a big impact. I think it was 200K subscription decline, but this was also based on sort of everything going on with Ukraine and Russia. So they've also cancelled or frozen accounts in Russia, which are being taken into consideration in that decline. But what is more worrying is more the outlook, where they say, hey, we're going to potentially have 2 million subscriptions drop. Now, whenever you're investing in these high high risk, I would say high growth companies, the moment growth stops, people now start to focus on the fundamentals of the business, the financials, the cash flow. What does the debt look like? Are they profitable businesses? And I think this is where a lot of people are not willing to pay a large multiple for Netflix. So it's a tough one, right? Because would they have seen such a large decline if their subscription outlook was still quite positive? Probably not. But also, I say, are the customers voting on the quality of the company? Because now, when Netflix first came out, it was the hot company. There wasn't that many competitors. Now that that whole landscape has completely changed, they're now facing competition from Disney, Hulu, so many different companies, which HBO, who have great content, and I can even argue better real estate when it comes to content. And Netflix is having to create a lot of new content, which they're spending billions on. And a lot of times they're not really hitting the ballpark. I think the last sort of viral series or whatever that came on was Squid
Squid
Game.
Game.
That was probably the last big thing, and I feel like that's been over a year ago that came out, right?
September.
September. So I think the way content is going to work in my mind, and we'll talk about that in the future, is a lot of subscribers are going to be hopping around in terms of what they're using. So they might use it for a month, 2 months while there's a series there, binge watch it, and then cancel that and move to another space. But my last point, also, why I think there's a fair element of sort of Netflix and other similar companies is we're seeing a large inflation play, which the cost of living for a lot of the customers are going up. So now customers have to look at, what is my outgoing? If I'm seeing energy bills going up, okay, I need energy. Obviously, I can be smart in terms of my utilization there. Water, that's going up, I need it. Do I truly need Netflix? If it's $20 a month, can I save that by canceling that or canceling a lot of my subscriptions? That could also potentially be the reason to it as well. But I'll pass on to the other guys. See if there's any
Not
other.
according to P from his latest Instagram story
Oh
about
yeah, I saw
cutting back on
P's.
subscription
Yeah.
models or not.
We'll come, yeah, but that's more from a wealth creation standpoint. No, just to echo on some of the points that Olu's mentioned, I think with Netflix, Olu, you rightly so, one of the first in the market, so they actually captured a lot of market share earlier on in their career. And I think, Daniel, to your question, is the first time investors have actually have doubts about what you said, Olu, the long-term growth. For the last 10 years, they're accustomed to growing just their subscription-based model. So I'll give just two reasons that I sort of noted. That one of the things which is a bit bleak is the on saturation of subscriptions on key markets. So they're finding it difficult to grow that customer base in some of the, like the US, like Europe, which in itself are the larger markets. And I think the second thing that they've noticed, when you talk about competition, Olu's listed a number of them. The price point for Amazon, which for Netflix, sorry, is a lot higher than some of the competitors. And when they had pushed, I think they had pushed the price up. I think from £10 to £11. Doesn't seem like much, but that resulted in the loss of subscribers. And I think the numbers are around 600,000. So it's the first time investors, and we can talk a little bit about some of the investors that have pulled out, are actually questioning, what is the future? What does it look like for Netflix, given some of those points? But sure, I'll
And
just share.
Pete, that
Yeah.
second point that you mentioned in regards to the price point, I think that's really interesting and concerning at the same time, because especially when you think about these sort of software companies, the luxuries of these software companies is that you can scale up, right? But not have so much overhead costs. So it's like if you have a software like Disney, they already own quite a lot of content that have already been produced. By making it online, you just need more service to store the users and whatever, etc. But your fixed cost doesn't really go up that high. But because Netflix is just started to in that creating content game, like a lot of the contracts that they had with other um media houses where they were borrowing a lot of their content and putting it on Netflix, I've cancelled and stopped. And now they're having to push out so much content and it's not cheap. So they're having to say, okay, where do we make this money from? So let's continue increasing the price. So that's a good point.
And that's quite worrying. The fact that the point Ollie alluded to about creating content and it's not cheap, because in 2021, Netflix announced they would release a new movie every week. At the same time, they had more than 200 million paid members, with 37 million people signing onto its services in 2020. And to produce a film every single week on a platform is going to take a lot of money. It's not cheap because these were high profile, actors. And I think we even mentioned in, our chats offline about, I think it was the film with, it begins with E. It was filmed in India.
It's Extraction.
That Extraction, yeah, we'll talk about that and how that wasn't a Netflix original, and other films of that nature as well. But it's just, I thought I'd just point out that trying to create or release a new film every week is demanding, is a lot. And it was at a time where there was a lot of growth. So they're thinking, we've had a lot of growth. We want to almost create stickiness to our platform and give new content to attract even more new users to grow even more. But sure, sorry, I kind of stole your thunder.
No, I think it's a great discussion. I was listening to great points and thinking, where can I really add anything else? I think in terms of the financial component we've spoken about, the inflation and everything. I mean, you can always think that when you see a company that drops 40 to 50% of its market cap in such a short, significant amount of time, people always focus on where it is now. But then I think it's also a reflection on maybe the valuation before being just astronomically high, which I think Olu touched upon. I think the only additional comments I wanted to add was just around the competition in particular. And I know you've mentioned it's a lot more competitive now. But if we look at some of the competitors that are there, so Netflix at the moment has got just over 200 million subscribers in 190 countries, which is impressive. And they've started in 2007, so that's almost 15 years. Now, Disney Plus, just as a comparison, started only 3 years back, just over 3 years ago, and is already at 130 million subscribers. And they've done that in 3 years. Netflix, it took them 15 years to get 222 million. So you add that competition, and if you think about the competition, so Disney, for example, they've got years of IP that they can reuse over and over again. And for a company like Netflix to pay the royalties, that's one of their highest cost items as well. And I think this is where you've seen them shifting into their own content, which is cheaper for them. But then the quality is something that's probably lacking, especially in recent years where they've not had as many hits. And again, if you just think about the competition, Amazon with Amazon Prime, this is a business that has AWS, it has their e-commerce business. They have almost cash machines that are generating cash in other parts that can fund the content. And if you even think about Apple as well, again, they've got such a strong business. The AirPod business alone is a multi-billion-dollar business, and this can generate all the money you need to fund the content. So not only are you against competitors with very deep pockets, I think the other element is you're against competitors that are offering a product for free. So if you think about YouTube, TikTok, these are also video platforms, and these are user-generated platforms that again have zero cost for users to subscribe. They give you an ad option, etc. And this again is eating up screen time and people's attention. So all of this competition, I think, as well, is really, really stiff, and it puts Netflix in a very tight hold because they don't really have any other elements of their business that generate as much cash as some of these other competitors we mentioned.
But great points there, sure. And on that note, but I think we also discount how successful Netflix have been because they've been tremendous because they were pioneers, they were first movers into the space. This is their first loss in subscribers since October 2011. So it's been over 10 years. And when you think about how much they've grown and how much revenue they generate, especially being ad free, that's absolutely ridiculous because we're forgetting that they don't have any ads on the platform, on the screen, or in between shows or anything of that nature. So I think we can get onto how they can possibly turn this around, etc. Later on, possibly with like a cheaper option with ads in there, whatever it may be. But P was mentioning about investors and how it's more of, I think, sorry, was it P or Olu about investors?
PP.
Okay, P about investors and I'd say their lack of trust or their lack of vision that the company has for the future. Because one of the best, in terms of what he does, Bill Ackman, his company Square Capital, I believe it's Square Point. I told you I'm tired, guys, so please bear with me. That he a couple of months ago, their company bought $1.1 billion of shares in Netflix, made an investment of 1.1 billion in Netflix. And in April, they sold and made a loss of 400 million. And okay, yeah, 1.1 billion is a lot. 400 million is kind of minuscule, but it's still a lot of money. And that was because he just didn't really believe in the direction that Netflix are traveling in. And for someone who's only been holding a position for only a couple of months, that's quite worrying. And I think that sends shockwaves into the market about the lack of trust, the lack of maybe vision, direction that they have at Netflix. And I just wanted to point that out and say, where do we feel that investments or people selling has an impact on the company or the view of the company perception?
It depends who, right? If
I mean, if
UI
Oluwakanela was going to
sell.
start selling shares of any company, mate, I'm calling my agent ASAP.
if it's some of our small investors, it's not going to move the needle. But unfortunately, a lot of people do copy big investors. Now, I used to read this. I read this really interesting way of looking at buying and selling stocks. You can always tell why someone buys a stock. You can never really tell why someone sells a stock, which I found quite interesting. So the people say everyone buys any asset, right, for one reason, right? You typically buy it to make profit. That is an easy, you buy stocks because you're expecting to make profit. In regards to selling doesn't always mean that you're selling it because you don't obviously believe in it. You could sell it for tax reasons. You want to write off some losses because you want to have some tax gain. You could sell it because one, you don't truly believe in the future, or you could sell it just because you feel like, yes, this might still do well, but I want to invest in something else. Or you could sell it just because you need the cash right now, right? I had to pay taxes one time, sold a few stocks. Doesn't mean that I don't believe in those companies. Hey, I had to pay some taxes from this money. So there's multiple reasons now. But I think when there's big whales in the market, like the Warren Buffetts, etc., typically when people see a sharp and decline or massive sell, it does translate to lack of confidence in the future vision of a company when it's such a large amount. Now, personally, myself, right? Is would I still invest in? Thankfully, I don't own any Netflix. I sold my Netflix a few years ago. Nice profit. But I don't own any. I don't own any at the moment. Will I get back into it? Me personally, no. Just because I don't believe that they have a cash flow generating element of the business. But yeah, I'm not sure why, but the rest of the guys, what do you think?
P, you want to go because you mentioned it initially.
No, actually, the only point I have actually, and with a lot of what we're analyzing today actually is quite similar in sense of we're looking at companies prior to the pandemic and kind of looking at how they are positioned now. The question I have around Bill's situation is, what was he looking at before when he was looking to buy? Because he's only held the stock for a couple months. So I think it just brings into question how you value companies at different times within the market. But yeah, I found that quite surprising. And I'm not sure if it sends shockwaves for other investors, but he's only held it for a couple months. So I thought that was a bit strange, if you like, from my perspective.
Just to build on that as well, Pete. So I think to add some color to what Daniel was explaining about Bill Ackman. So this is a guy who has been notorious in terms of making activist investments, so betting against a company to not do well. And I think with this Netflix one, when he made that investment, he did a whole press release and a media run, basically saying that he wants to switch tactics and become more of a friendly investor and invest in companies that he believes for the long term will generate a good return and their products that he believes in. And I think that also amplifies that him suddenly pulling out after a few months, after announcing that he's going into this as a long-term play, is interesting and probably sent a worrying signal to the market. The other thing that I think was interesting, and this is probably another episode, is a man of Bill Ackman's pedigree in terms of his investing track record. For him to make $1 billion bet and then take his chips off the table for a $400 million loss, there might be other people who are investing in their own spaces and maybe they're looking at a loss, but their ego is telling them, or their pride is telling them, that this is going to turn around. I can't take a loss. I'm gonna ride it to the bottom. But this is someone who does this as a professional track record, is willing to have people look at it or talk about it in a certain way, but is still willing to take that decision because, again, in the long run, he probably has a better hypothesis of the stock now. So I think in that sense, there was some personal lessons there in terms of how we invest and how we also adjust our decision making as well.
And sure, I love that point, right? That taught me a lot to know, okay, when is it time to walk away? And walking away doesn't mean you walk away and now you put it in cash and just keep it in cash. Is no, I believe I can invest that somewhere else where it could recover or generate more of a profit versus me waiting for it to recover. So I believe when you do have new information that the outlook of a company is changing, the vision is completely changing, and you don't agree with it, then you need to say to yourself, okay, let me vote with my capital. Is it time for me to remove that off the table and put it somewhere else? Yeah, it makes sense. But that was a lesson learned for me from that.
So in terms of we've seen what's gone wrong for Netflix. We've seen that they've increased their prices for subscribers. We've seen that they've had to pull out of Russia due to the ongoing conflict. We've also seen Bill Ackman's position being removed from Netflix itself, and of course the $50 billion wiped off the market value. What do you think Netflix can do to change? What do you think they can do to maybe appeal to a new market of customers, given that there is highly competitive space with Disney Plus, Hulu, Amazon Prime, and all the others that offer more than just, say, series, original series as well, but live TV, live sport, and other things of that nature? What do we think, or what do you think they could do to kind of turn this around?
So I'll take one point and then give the rest others to the guys. So they've got to figure out the pricing strategy. For the entire lifespan, they've always prided themselves on just sort of having that one price to basically have access to the content. And when we look at basically saturation in key markets, if you want to start penetrating more emerging markets, Asia and places like that, you've got to look at different. I think it's like tier pricing. So perhaps you may do, if it's £11 today, you might say, okay, £4 to get access to a number of different categories to a certain pieces of content. If you want more, you have to pay an extra £2-3, and that type of pricing strategy will or should increase and widen the subscription base. So I think a pricing strategy is one of the things that they have to sort of relook at and move away from just the one price to multiple. Sure.
I think on my end, so taking price out of it, I think where they could have opportunities is actually building on the success that they've had and where they own the IP, because from that you can generate potential additional revenue streams. I think the recommended to watch on Netflix is probably one of the best AI tools that we've seen on any product. And I think if you leverage that AI and apply it to maybe another type of product, building on your preferences. So, for example, if I'm a big fan of House of Cards, while I'm watching House of Cards and they know that I've just finished a series on that, why not send me links to products that I can buy around House of Cards? Or if they own the IP of Stranger Things, for example, which has got a lot of themes that children appreciate, what Disney does is if children want to experience that in real life, you can go to the parks, you can have that experience. Now, why does Netflix not look at the idea of opening up a park to test? I know we're going into an inflationary environment where maybe the cost of living, etc., is increasing, but this could be an additional revenue stream building on what they're already doing and what they've built a lot of success in. And I think companies like Disney, etc., have done that really well. I think the one other thing is regarding the content type. I think they've done great with what they've done. It's almost like a guy who entered the party first. He was the guy because he had all the latest clothing. He seemed really cool. But then after that, him opening the doors opened up people to like Disney, etc., who've got much cooler content of clothing or everything else, and they're now the cool guy that everyone wants to hang out with. And now Netflix looks a bit old. So I think they need to make a bold move on their model, whether that's parks, merchandise. The other thing is maybe sports. I think Amazon Prime has invested in sports. Netflix, if they were to pump in a few billion to get Premier League global rights, would that not increase the number of subscribers as well? But I think they need to try something different that their competitors aren't doing, and something like that could work.
Go on.
I was going to jump on one point just to basically, one of the red line that runs through what Shua's mentioned, and I'll give it to yourself, Olu. They've got to spend more than the competition. So currently today, I think they're spending around 17 to 18 billion for customer acquisition and marketing and things of that nature. The competitors are spending upwards of 20 billion. So 20, 30 billion. I think they're going to really have to look at something drastic and going from 18 billion to maybe 40, 50, and even upwards. So that's like a basic 101. We need to acquire more customers. We need to spend more than we've been spending.
Yeah.
Olu.
So I was listening to both of your points. P, on the pricing element, I'm against creating reduced tiers of content or pricing. Reason why I say that is, do you guys remember how much Sky used to cost our parents back in the day?
It's still ridiculous. It's still ridiculous now.
It's still,
I don't know how much.
Relative to the time, it's still go ahead.
Yeah.
But
so it's like 100. Let's just say, for example, £100. Sometimes it would cost a household to get all the different channels. So in terms of, we're now changing to this content world where you'll get lots of different providers. Some will be £8, £15, £20, whatever, etc. But it's still significantly cheaper than what content used to cost us previously. And I would say that the issue that Netflix is facing is less around the price. I don't think it's the price factor. I think it's really the quality of content that they have. And people are voting based on unsubscribing. And I think they're trying to say, oh, sharing passwords, the price going up. That's the reason why people are leaving. No, the reason why people are leaving is because your content is not that good and it hasn't continued to be good, right? And I honestly feel like the big thing they need to really do is, one, continue to invest in quality series like House of Cards. Like, that was a game changer. Those sort of IP that they own that's quality will get people onto your show. Like, if you go, no matter if it's £20 a month, whatever, if it's a game-changing series, as big as House of Cards, The Wire that used to be on HBO, those sort of massive series that are quality, people will pay whatever the price is to pay to be on it. Now, when they're spending on that content, now the question is, how do you fund that content? Because as inflation increases, taking on debt might not be the answer. So again, I go back to what Shuwal mentioned, and is they got to figure out a way to create some sort of cash cow within their business. And I don't think they've made an effort in, like I see with my Amazon Prime, where I can scan up, I can see who is the actor on it, what movies they've been on, whatever, etc. Why can't they do that in terms of merchandising, right? You scan up and it's like, oh, this is the t-shirt that the character's wearing, this is blah blah blah, and you can just order it directly, and that way you've got a sort of Amazon style sort of e-commerce site, which is you're able to buy merchandise from it. So they got to figure out a way to create some sort of cash cow, which would then fund them spending a large amount on marketing and content, like we discussed, to ensure that there's some sort of quality content to keep. I'm not a fan of ads, like doing ads for there's people that talk about doing ads on Netflix. I'm not a fan of that because it's gonna just ruin the quality. In my mind, it's gonna ruin the quality of it, and it's gonna turn into, it might potentially turn into YouTube, where yes, you got some great content on YouTube, like Take Flight Podcast. If you haven't watched us on YouTube, check it out. But you've also got some nonsense, right? There's some other podcasts, not going to mention any names, where I'm like, like what's going on here? And that's what happens when you've got certain ad models. You can't always regulate the level of content there and the quality of it. So I'm like, focus on the quality of the shows that you're releasing, and customers will vote by paying.
So a couple of points. And I like what's happening here, because I kind of liken it to the fact that us four right now are sitting in a boardroom meeting, and we're having to decide, where do we prioritize to turn this business around. So I agree with you, but I wouldn't prioritize quality content as of yet. And the reason being, because I think it will take longer to do that. So if you give me the data, it tells me that half of my subscription base are sharing accounts. So I just say to the compliance team and say, look, how long would it take to turn this situation around? If we can basically crack this situation that we've never tackled before, because we've always been used to growth, how much revenue can that unlock? So that starts to change the game, and then we have a different conversation with investors. Then I think
with that first point, do you think by cracking down on that, let's say for example myself, if you guys crack down and say I can't share, I'm not subscribing tomorrow.
Right, but you have to understand the size. We're talking about 100 million people. So you will lose subscribers, but then ultimately there will be a portion of revenue that is unlocked. So that's kind of, and how quickly can we do that? And I think the second thing, the reason for the pricing is actually to increase your base in sort of emerging markets. So the key markets you kind of already have a foothold on. But if you want to tap into other markets where they can't pay the 10, 11 pounds or whatever it may be in their currency, they can get in for a little bit less. And I think I'm just thinking about how quickly can we do those 2 points versus quality content, because I think that takes longer to get right. And I think the third and final thing I'll mention, you spoke about, I really like this because I feel like we're debating now. You spoke a little bit about not necessarily liking ads and how that's necessary works. If you look at the competition, Disney are kind of taking that path. So I kind of, for Netflix right now in their position, everything's on the table. You've got to look at all different avenues to sort of turn this around. Because they've not really actually they're not accustomed to doing something different. We're like Shaw said, first guy in the party. I've been here for the longest. I'm used to growth. So that's just a couple points to.
I was going to say, I've completely listened to what you all said, and I agree with a lot of it. I think in terms of how they can turn this around, I think you have to focus on the customer, because the customer is what's paying your bills. The customer is what's giving you your revenue. And Netflix's USP is not being ad-free. So they should certainly tap into that, because your USP is not saying that you're an ad-free streaming service. Why not tap into that? I think in terms of how they can maybe get more customers, create stickiness, is potentially adopting like an Amazon Prime model, where you have an annual subscription, which makes it a bit cheaper. At least you can then forecast the number of users that will be with you for at least a year before these incremental hike in prices. because monthly you have a fixed price, but you can cancel at any time. At least if you have an annual subscription model, you're trying to target those who want to be with you for the long term. They could also explore providing some of gaining rights to some sort of sports or live TV content. I think Apple TV do it where it's BBC iPlays embedded into Apple TV. You also got Amazon Prime embedded into Apple TV, and trying to get multiple different other third-party content providers embedded within Netflix could be a win. Even down to the point of doing weekly releases of original series or content that they have. I think most of us watch Top Boy, and even as an actor or as a producer, you're working so hard to produce such good quality content that people will now binge watch in a day. That's kind of like, it's good, but it's also disheartening, because for something that you've worked on so hard, and I saw one of those memes where I think someone went up to, was it Kano, and said, yeah, I watched that already. I watched it all. He goes, "Raw, we worked hard for that, We worked hard for that, and you watched it in 8 hours. You watched it all in one day." It's like, and I think that level of anticipation of looking forward to a new episode week on week is sometimes nice. It takes you back to the kind of old days where things weren't so easily accessible, easily available. You had to wait. It created suspense. It created some sort of cliffhanger rather than just saying, I'm on to the next episode.
Daniel, just on that real quick, I was disappointed when I noticed that all episodes were released with Top Boy. I was actually mapping out the next few weeks, doing a bit of takeout, Thai food. Let's get this, and it was all there. So and in the end, you watch it all. So it's a great point you mentioned.
I was the same, and I felt like I had to watch it because people were sharing and spoiling things on social media that you had to now go and watch it. Otherwise, you think, okay, I haven't watched it in a month. I've seen most things. What's the point now? I'm not going to bother. But I think also the last point is Netflix have to really think about who their competition is. And in the 90s, I think it was before like the launch of the MP3 and before Apple, the likes of Sony, they dominated the Walkman market. They dominated it completely. I think I had a Discman, I had a Walkman, I even had a mini disc player by Sony. Those were bad boys. And Sony were really comfortable. They were leading the competition. They were comparing themselves to like JVC, Panasonic, and the likes. They weren't comparing themselves to Apple. They saw Apple was completely in a different industry, but yet Apple were the ones that would come in and really disrupt and take the market share through the iPod. So as Netflix has probably evolved over the years, they probably haven't really thought of the likes of Amazon or even Disney or others. But you also have to think, even as I say that cluster of Amazon, Disney, Netflix, have to think of those in different markets who may just come in and really disrupt and take a lot of the market share. So I think doing some SWOT analysis and also some competitive analysis is really key and fundamental in ensuring that the long-term outlook, long-term vision, long-term growth is successful.
But I find it funny that you guys are talking about them cracking down on sharing accounts.
I'm not talking about that.
No, I am. It's interesting how me and Ollie differ. Pricing,
the reason why, because it's funny because the company tweeted in 2007, "Love is sharing your password."
Yeah.
And now you guys want to tell me it's not. I'm just gonna ask the question: where did the love go? Huh?
No, but that's fine. Yeah, that was
you capitalist.
When? 2000 and when?
2017.
Well, that's when you're in. They just started up in 2007. So startup phase versus 15 years on, multi-billion-dollar business. You're in two different phases of the life cycle.
Tweets can't be deleted.
I would even go as far as saying that they spend as much time at that point focusing on the number of subscriptions going up. No, but then you're sharing accounts. It's probably a number of users, though. Yeah. As in addition to
because
sales.
I think they see and that's the part I'm afraid. So sure, it sounds like you're talking about like that was the honeymoon stage, and now.
I just have one question to ask you, Olu. Back in 2007, were you in a relationship?
2017.
2007. When did they tweet that?
2017.
Oh, 17. Okay, 2017. Yeah. Were you in a relationship?
You're 27, Ollie, just so you know.
I was 27. No, I wasn't.
Where's this going?
Let me do the maths. Make sure. No.
You weren't? Okay. What? No, because I was going to say, I mean, Netflix had said that in 2017 when they were saying, like, what was the message?
Love is sharing a password.
Yeah, and I'm saying whoever you love in 2017 may be very different to who you love in 2022. It's a different world. Love changes.
That is true, but it's just being careful that you don't lose you don't lose your core customers. But I think this is good. We all gave like different perspective and different views, so was a good debate.
Okay. Any final comments?
No, I think when I was listening to this and also reflecting a little bit before the episode, I think if you boil it down very simply, in terms of economics, and you just look at demand and supply, right? Demand wise, lockdowns have now been lifted essentially, right? So people are going out more, and also the cost of living has increased primarily around the globe. So if you take those factors, demand will naturally reduce. And then in terms of supply, I think what we've spoken about regarding competition, the number of players, deep-pocketed players as well, the supply has increased massively. So if you just combine the lower demand and high supply, essentially, I think the next round, the number of players that are in the space, it can't stay the number of players, especially as Ollie mentioned, the interest rates increasing, the cost of creating the content just goes up. So I think consolidation is what the natural pathway would be. And maybe the number of players we see now is really the peak number of offerings to us as consumers. And I would assume and make a bet that in the next 5 years, one of these businesses that we've spoken about would have been consolidated by some of the others.
Or
That's
Elon
my
Musk
bet.
comes to buy them all.
Yeah.
Or Twitter launch something. Who knows? But no, thank you all for your input. Thanks. It's been a great conversation. The listeners, we hope you've enjoyed it. Another kind of case study on the business, Netflix, which we're all very well accustomed to. But as always, if you have any feedback for us, you can find us on Instagram at Take Flight Podcast. You can also watch this episode to see our interactive faces and the way we actually engage with one another, all on YouTube. So all of our episodes, free content on YouTube, ad-free, we hope. Well, it depends on your YouTube account, but you can watch them all there for free of charge. Until next week, stay safe, stay well, and God bless.
Take off, take flight with you.